So Halloween isn't just exciting for those trick-or-treaters out there. It can also be a good time for investors to enter the stock market. Local financial professional Mark Triplett is here to talk about the history behind the Halloween effect and also how it could impact your finances. Mark, always glad to have you here. So first of all, tell me, what is the Halloween effect?
So it's a theory. It's a theory that stocks perform better between October 31st and May 1st of the following year. Some of our viewers may have heard the phrase sell in May and go away, which is another popular strategy, basically saying liquidate your investment accounts in May and then hang out and let the summer months pass and then enter the market again in the fall. But that may not be the best strategy. Success in the stock market comes with time in the market, not timing the market. And there is some truth that the fourth quarter historically is one of the better months, or rather quarters of the calendar year. And so that does get a lift to the end of the year. But really, we encourage our investors to have a long-term investment strategy and not try to jump in and out and trying to time the market.
And so I want to dive into that. So why exactly do the stocks perform better during this time compared to the summer? I know in summer, you got more people out there doing more stuff. Maybe they're spending more money, but then you got holiday shopping on the other end of things.
Yeah, that has a lot to do with it. Lift from holiday shopping for sure. We have a lot of revenue pouring into the economy at that point. Historically, October gets a bad reputation. The panic of 1907, the market crash of 1929, Black Monday of 1987. It's not the worst month of the stock market historically, but oftentimes is thought of as it. But it's also brought more the end of more bear markets than it started. I think one of the other things that we want to pay attention to is the election cycle as well as we're coming into the fall. Oftentimes folks want to sit on the sidelines, particularly during a presidential election year, just to see what happens. That could be a mistake. A lot of money sitting on the sidelines comes pouring back into the market after the presidential election cycle is over. And often the year following a presidential election cycle is really good for the stock market. So starting to kind of get into that now as opposed to waiting around could be a better decision.
So for this fall, what can we expect? What is this going to look like?
Well, I think that as an investor, you need to have a long-term plan. And this fall, I think what we're going to see is a lot of tailwinds that are pushing us in a good direction. Inflation's come down quite a bit. We've seen the Fed starting to cut interest rates. We really have some tailwinds for the market itself as well. I mean, the market's been up about 33% if you look at the S&P 500 a year ago to now, and we have a lot of momentum going forward. But with that said, folks that are near retirement, really try to start thinking about how you're going to immunize your lifestyle from market risk. We can't control the market. We know it's turbulent at times, but we can immunize ourselves by deciding when we have dollars exposed to the market and when we're going to need those for our lifestyle or maintaining our lifestyle, and making sure that the purpose and the timeline of our money lines up with the decisions that we're making.
Mark, always giving us great information, great advice. Thank you very much, sir.